Well, hello everyone, and welcome to the final Something to Talk About show for 2020. Next year, a whole new ball game, but we're thrilled to have you with us here for this final show of the year. And Vaughn is on her way. I think she is putting her tax papers in order for the show, and she will join us shortly. But we decided to have a little special discussion since it was the end of the year. What that means is now you got to start gathering all the information together to take to your accountant for preparation of your taxes. And because of everything that's happened in 2020, I think it's going to raise some questions as to how does it affect how we're accounting for this year. So we've invited a very special friend, Robert Gralla, who's a CPA and a good friend, to join us in the conversation. Good morning, Robert.
Good morning, Stuart, and good morning to all the followers and listeners of Stuart. And thank you so much for the invitation this morning. It's a pleasure to be on your show.
Well, it's great to have you, and you know, I have never been one to try and second guess what the government is going to regulate from year to year, and especially when it has to do with my money. That's why it's always a good idea to put it in the hands of someone like Robert, who says, "Yes, you missed this deduction," and oh, there's a deduction we didn't miss.
Hi guys.
Hello, Vaughn.
I got your email and I'm on.
Welcome. I think you know Robert.
Hi, Robert. Good morning.
And good to have you here.
Good morning.
So what I just introduced Robert, and I mentioned that what we're going to be really kind of focusing on today is getting ready for tax preparation. And I think that one of the first questions I'm going to ask Robert, if you could share with the audience, is, are there some regulations covering the tax preparation of your 2020 taxes that we haven't seen before that people need to be aware of? And I think then my follow-up question is,
well, during the year in
go ahead.
Well, during the year, as you know, there was a couple of changes to the tax law due to the Coronavirus CARES Act and with the new stimulus act that went through recently. In general, the tax laws have not really changed. It's the same tax laws that we've always had: income, expenses, deductions, net income, next taxable income. There isn't anything that profound that made huge changes in the tax laws. They're just small changes, and they have to do with things like IRA, those PPP loans for businesses, and things such as that. If you like, we can talk a little bit more in detail about some of the things that we can deduct, but in general, there have been some changes, but there's nothing that has been so earth-shattering that's going to change the realm of tax preparation for 2020 and beyond.
One of the first questions that somebody had asked me to ask you is the stimulus checks that everybody got earlier in the year, and supposedly they're supposed to be releasing them even as of today. Is that money tax deductible?
Yeah.
Or do you have to claim that as income for the year?
That's a very interesting question, and everybody's been asking that question. Basically, that $1,200 stimulus, or the amount that you got for that stimulus check, is a early distribution of a tax credit for 2020. It's not taxable income to you. Basically, what the government did was this. They said when you file your tax return for 2020, if you're entitled, you will get a $1,200 tax credit. So what the government did to stimulate the economy is they said, well, instead of waiting to file your 2020 tax return, let's give you the credit beforehand. Let's give you the credit now. So what happens is now when you're going to file your 2020 tax return, they're going to ask a question. did you get your stimulus check? And you'll say yes. So you won't get that additional tax credit because they gave it to you beforehand. If, for example, if you didn't get the tax credit, whatever your tax would be for 2020, subtract $1,200. So in essence, the government said, we're going to give you that $1,200 in advance, and then we're going to just deduct that $1,200 when you file your tax return. So basically, they give you $1,200 of free money, non-taxable income that you don't have to repay. Well, under certain circumstances, you do have to repay it, but it's free money that's non-taxable that the government gave to you. And may I say this? Let me just backtrack to the way beginning of the program before. I just want to mention this, and I'm required to as a CPA, that this is just general tax information, just general tax talk. It's not advice. It's not tax advice. And if you need tax advice, I recommend that you seek a tax professional or seek your tax preparer or the person that prepares your tax returns. Thank you.
But it's also a good idea that any of these notes, the people that are listening and watching, jot it down, because it's definitely something to talk to your accountant and or CPA or tax preparer, so that make sure that you are entitled to every deduction possible, that you're not overlooking something. Now, another question. Go ahead. We have a little bit of a delay for those that are listening and watching. We have just a little bit of a delay here, so bear with us. Go ahead,
okay.
Robert.
Actually, with the delay in what you said, I let's just move on. Let's just move on to the next question,
okay? Modern technology, gotta love it.
That's right. There's been a controversy over the last few years about charitable donations and medical expenses. Does a person have to keep a record of all their medical expenses, of all their donations, or is there just a threshold or something for donations that's automatically deducted from your preparation?
Okay. Usually when you give a charitable contribution, the organization that you give it to, okay, will give you what they call a contribution letter beginning of the next year for what you've donated to them throughout the year. Okay, and that is pretty much as good as gold when it comes to an IRS audit for verifying your charitable contributions. Usually, I think the number is $250. If you give more than $250, you have to have, they're required to give you an acknowledgement letter, a charitable acknowledgement letter of how much you donated to them for charity throughout the year. With that, you can keep your canceled checks, credit card receipts, but that letter is as good as gold, and the IRS will accept that, on an audit. So technically you don't have to keep canceled checks and credit card receipts and everything else, but it's not a bad idea to keep that. Under $75, there's no requirement for any type of document. So what I normally recommend for my clients to do is when they do give a donation to a charity, a cash donation, to also keep a copy of the canceled check or the credit card bill, the credit card receipt, as well as the acknowledgement letter that the charity gives to you. So if there's ever a question, you always have the backup for it. As far as medical expenses are concerned, what you're really required to do is keep copies of the bills and the credit card receipts that you provide to the service provider, the doctor, the hospital, even the pharmacy. A worst case scenario, if you ask the doctor's billing office to print out a statement throughout the year of what you've paid them, that will work as well. Now the thing is this: people think that, I spent, let's say for example, $5,000 in medical expenses for the year, I can deduct that all. What I think is, I did spend $1,000, but my insurance company reimbursed me. So the thing is that it's only what I call out of pocket. So even though you did spend $5,000, you were reimbursed, let's say $3,000, you can only deduct $2,000 of medical expenses on your tax return. And getting medical expenses, you have to hit certain thresholds before you can deduct dollar number one. You have to have what they call over 7.5% of your adjusted gross income before you can deduct any medical expenses. And any amount over that 7.5% threshold, that goes into your itemized deductions. And then you have to determine whether you can even itemize or not. This past year, 2020, they raised the standard deduction for a single person. Actually, raised it again for 2020. For a single person, your itemized deduction is $12,400, and for a married couple, it's $24,800. And what that basically means is, if you have more itemized deductions, which we can talk about a little bit later, what actually itemized deductions are. If you have more itemized deductions than the standard deduction, you itemize. If you have less than the standard deduction in itemized, you just take the standard. The government gives you a standard amount that you deduct on your tax return. So your medical expenses go into that itemized deduction. Your charitable expenses go into the itemized deduction. And to make it complicated, and I'm telling you, when it comes to taxes, there is no simple question. There is no simple answer because so many things are so interrelated. The government did something different for 2020. You can deduct $300 of charitable contributions without itemizing. I mean, obviously, you have to have given $300 in deductions or contributions, but they'll give that to you deduction with itemizing. So, I hope that answers your question, or did I give you too much information?
No, there's never too much information, that's for sure. But what you just said is kind of the foundation for what I started at the beginning of the show, and that was, if you have questions, it's good to have a CPA, an accountant, or a qualified tax preparer to run all this information past, because you can go down to the big box stores and order TurboTax and try and do it on your own, but I don't think it's anything like trying to do it through an individual who is as well versed on all of this as you are.
Yeah, absolutely.
Yeah, it's funny on the back of the saying. I'm not saying it's a saying that gentleman read a day, and it says, if you think the cost for a professional is expensive, try hiring an amateur. And I say that when it comes to tax preparation. A lot of people think they can themselves, and that's fine. Give them a shot, let them do it. And sometimes tax is not that complicated that they can. But sometimes you need a professional because for two reasons. One, it's possible you can save more money in taxes by using a professional. And two, it'll keep you out of trouble with the IRS as well. You might do things on your tax return that you may not be allowed to do, or you may not follow regulations as well as you're supposed to. And you get what I call an IRS love letter, okay? Which is basically a letter that says, "Dear taxpayer, you owe us money." So
we need to talk.
Yeah, definitely.
I sent in a question, and I think I knew the answer. That you still have to maintain your records for 7 years, and all. And Robert's answer was yes. So it is a good idea to get yourself a big plastic bin and keep your tax returns and all the backup information for that period of time, just in case you get that lovely letter from your friends at the IRS.
And a follow-up question to that is, how do you dispose of it?
I recommend.
This is awful. Sorry.
Okay. Well, first of all, I'll answer the easy question first. To dispose of it, I would rather or bring them to a place that they're shredded. I wouldn't just rip them up, put them in the garbage, or just throw them in the garbage. There's a lot of sensitive information. It has you could have your brokerage information, your bank account information, social security, even the date of birth. Sensitive information for identity theft. I would recommend shredding anything that you have to do with your taxes when it's time to throw them out. Now, getting back to the 7 years, that's what I recommend. First of all, on a regular tax return, statute of limitation for an audit is approximately 3 years from the date you file or the extended due date. So let's say for 2021, you file a return April 15th, excuse me, for 2020, you file April 15th, 2021. If you count 3 years, that's 22, 23, 24, April 16th, statute run out and audit you. However, in some instances, they still can. They can have up to 7 years if there's tax fraud, tax evasion, and things such as that, or over a certain amount of money that you didn't record and report as income. So it's always good to save things for 7 years, and that's what I recommend my clients. Minimum 3, and I would say 7 years, you're good to dispose of tax. And the other thing is, if by chance, okay, something happens and you need a tax return after you dispose of returns and your information, you can get transcripts from the IRS. There's various ways to get transcripts. You can go back possibly 10, 20 years transcripts from the IRS if you really need them.
There's so much to know, much to cover. Now, I have an area that I want you to cover because I've always wondered about it. If someone has a investment portfolio, 2020 was a very good year for most people that had investments, which means they're going to have dividend income. Is it a good idea, and you only have a day or so left, to contact your accountant and get an idea? Because if your income level says that you made $20,000, you may have to pay $20,000 to the government in taxes. Do you have an option of making donations up to $20,000 in order to reduce that tax hit?
Well, yes, as I said, there's no simple answer. Yes and no. $20,000 worth of capital gains. First of all, capital gains, which means you put stock or security. Over 1 year, you get preferred tax rates. It could be 5, 10, 15%, it could be up to 28%. But normally you have a lower tax rate for your capital gains, and in some instances, there's a zero tax rate for capital gains. Your income is low enough. So what you're basically looking to do, what you're saying is that make charitable contributions to write off or shelter, so to speak, the actual gains that you're making in the stock market. Yes, that can work. Okay, it also depends on how your itemized deductions are. If you make a $20,000 contribution, and that's your only itemized deduction, you can't do it because you're below that threshold in some cases. But yeah, you can make charitable contributions, which would lower up the extra tax you will pay for that capital gain. But once again, every tax return is different, and before you would do something like that, I would recommend you seek help from your professional tax preparer or your tax advisor. The case is a little different. Talking about capital gains, just as a side note, between now and the end of the year, if possible, if you have capital gains, look through your portfolio, see if there are any capital losses. You could write those losses off against your gains. So let's say, for example, you had a great year in the market, and certain stocks you made $20,000 in gains. Congratulations, you did well. But let's say you had $5,000 in some other stock that were just really, really bad. Sell that stock before the end of the year. You can now deduct that $5,000 against the $20,000 gain, and lo and behold, you only have a $15,000 gain. That stock is doing bad. At least you might have lost money on it. If it's not, at least utilize it. Save some money on taxes with that. Make sense?
Yeah, I mean, it does, because I would rather give it to a charity than to give it to the government.
Yeah.
That makes more sense to me. So now, Vaughn, you're going to be faced. You have a friend, Daniel Rubin. If you can see that on the screen, Robert, you can address that one to Daniel.
Actually, that's my nephew. Very big sense of humor. He kind of takes uncle. I call just answer his question. Haroset regulations. The Passover Haroset regulations covers what he's talking about. So we can move on to the next question now.
Now, Vaughn, you have got you're facing in the new year a wedding in the family. So there are going to be certain expenses that are going to be added. Are there any kind of options that Vaughn and her family and her future daughter-in-law's family can look at as far as ways to reduce their tax hit when they have upcoming expenses like a wedding?
That's a good question. No.
No, honestly, it's a personal matter. It's a personal affair, and there's no tax deduction if you have a family wedding. There just aren't any. Once again, also, it's something that's kind of personal, and you might want to speak with your tax advisor just to go over some of the wedding plans if there is something. But I would say 99.9%, 99.999, there are no tax deductions, unfortunately, for a wedding. I mean, think of it this way: you're spending all of this money, but you're getting a wonderful daughter-in-law, I guess.
And you can't put a price on that, right?
Worth it.
That's right. In fact, there may not be a tax deduction, but there's going to be an additional liability in the family.
Yeah, exactly. Well, speaking of family, I actually have Phil. I have my husband, Robert. His name is Phil. He's sitting next to me here. He wanted to listen in to the show here, but he's asking a question. How about top 3 watch outs when preparing your own tax return?
Okay. If you're using, like, for example, TurboTax, they have at the end review the return. I would definitely hit that review button and make sure that everything passes muster, that there are no open items or everything looks good. And also do what they call an audit on TurboTax, because that might open up categories that look kind of funny to the IRS. They could be totally legit, but I would definitely run by something like that because they go with statistical analysis. In other words, if you make $50,000 in salary and you're contributing 150 in charitable contributions, that might look kind of funny, and they'll open up that audit review and tell you whether that looks good or bad. I mean, other than that, what I would do is I would double check all of the numbers. In other words, I would make sure that when you're putting the information in from a W-2 form for your salary, your 1099s, I would make sure that you don't crush numbers, transpose numbers, make sure I put down correct. I would just make sure that everything's reviewed properly, even as close to the Social Security number. Your name is spelled correctly on a return. Check the Social Security numbers that they're correctly addressed. And double check all the information is on the tax return that is put on correctly. All of the numbers are put on correctly. I can go into detail, it will probably take a long time, how to summarize certain things. Like I would take, for example, if you had 3 or 4 W-2 forms, I would add up all the gross salary in one number and make sure that that agrees to what's on things line 1 on the tax return for gross salaries. Do like double checks. And the best thing you can do is ensure that everything is put on your tax return correctly. And I would say, look at the return when you're done and make sure that it makes sense. But with all due respect, as a non-tax professional, you're looking at a return and you're hoping that the tax software did it correctly. You're not really sure what it looks like. I mean, for example, I use the tax software as a tool. It doesn't prepare the return per se. I mean, it puts the numbers on the forms for me, does the calculations. But then I look the return over, and in my experience, I go, does this tax return make sense? I compare it to last year's return, which is another good point. Look at last year's return. A lot of times what will happen is, let's say you had 3 or 4 banks that gave you interest in 2019, and now you're preparing your 2020 return, and you only have 2 banks that you're showing gave you interest for the year. Well, did you close out those accounts, or did you forget to put those numbers on the tax return? Use last year's tax return as a guide for your 2020 tax return. That's the best advice I could probably give for someone that's preparing their returns. Or you can have possibly a tax professional over for you. Just give it an eyeball before you send it in.
My father.
Yeah. Phil said that's all very good advice. And we actually have, pardon me, Phil's father who does our,
He's a former accountant.
he's a former accountant. And so not only do we feel like we're in professional hands, which we are, but we're also, we have a family member who we can, you know, obviously he's looking out for our best interests and knows our family very well. And it's nice to have one of those in the family.
Oh, definitely. I mean, it's good and it's bad to have an accountant in the family.
Yeah.
You can rely for help, but in the family, I get a lot of phone calls a lot of times. I got a lot of advice, but I love my family and I help them anytime I can.
Good answer. Good answer. Well, you can see that I'm clearly not contributing a lot of comments to this conversation. I am not the numbers person in our family. It's clearly Phil, which is why I have him sitting in here today, because I was great in English and reading and all of that. Not Phil's the numbers guy.
And expenses.
Well, he said I'm good at spending the money, not counting the money.
I always say that Lauren and I have a mathematical relationship.
Yes.
I'm in charge of addition and she's in charge of subtraction.
Very good. Exactly.
Yeah.
Exactly.
So, but
sometimes they don't balance.
Most times
That's
they
like
don't.
Client, she's in charge.
You know, Robert, as people start to get ready for the upcoming tax season, Lauren is very meticulous. She takes all of the medical expenses, puts them together, and then puts them on like a cover sheet that lists the name of each doctor and how much was spent. She'll do the same thing for donations. Is this a good policy for people to do? Gather all the information and then try and summarize it in a page or two to not only present to their accountant, but also to keep in their records?
Yes, excellent. I always say when you're preparing your taxes and putting together information like that, Microsoft Excel is your best friend. You could list all of the different items on an Excel spreadsheet and it will total it up for you. And then you can take that number, have a summary sheet. So yes, it's always good to have a spreadsheet like Dr. A, the date you went there, the amount. Dr. B, the date you went there, the amount. Charity number one, church number one, how much you contributed and the date. Church number two, how much you contributed on the date. It's always good to have an Excel spreadsheet to put all those items on, add it up, and then you can have a summary sheet. And you can give the summary sheet all the Excel workbook to your accountant so they can look at all the detailed work as well. Find all the actual backup receipts that you have. I don't, not necessarily. It depends. The tax preparer might want them or may not. If a client came to me and said to me, I gave a doctor $25,000 for whatever procedure or whatever they did, something like that, I would want to see the actual receipt just to double check to make sure it's a valid receipt. But if someone came to me and said, "Oh, I went to the doctor and my copay was $10 or $15," I would not necessarily need to see the receipt. It's a small amount. It's immaterial. Just as a side note, and talking about medical bills, as a little tax tip, you can deduct the mileage as a medical expense from your home to the doctor's office or the medical facility or the provider and back home. I forget what the number was in 2020. It was 1 cent or 17 cents a mile. So let's say you do, 100, 200, 300 miles a year from your home to the doctor or to the hospital. And let's say it's not so much you, but it's your spouse that you're driving. Same thing. That mileage is deductible, so you might want to keep track of your automobile mileage when you're going to medical facilities, doctors, hospitals, and things such as that nature. The other thing is the same thing for charity. I mean, if you go to the church or the synagogue for the religious service from your home to there, you can't deduct that mileage. But let's say you're on the board of directors for a church, or let's say you're doing some sort of a charitable event, and you're on the board of the charitable event. That could be considered charitable miles. That's deductible as well for charitable contribution purposes. So for medical purposes, you might want to keep track of your miles. For charitable contribution, you might want to keep track of the miles that you have on your vehicle for when you're serving on a charity or on a board, or you're doing work for a charity. Not the mileage going to and from the service, but more for work that you're doing for the charitable organization.
Did you say that mileage is calculated at 17 cents a mile?
Don't quote me on that. It's 14 cents or 17 cents. And it changes every year. And, I'm an accountant. I'm a CPA. I'm not the Encyclopedia Britannica. I don't have every single number memorized. A number like that, I should know, but it's about 14 or 17 cents a mile, somewhere in that range. Whereas business mileage is over 50 cents a mile. But it's a little bit. I don't think it'll make or break whether you're going to pay a lot of money or not in tax. But it's a little gimme that the government gives you, and you might want to take advantage of it if you can. Okay.
Yeah.
That's what I recommend.
No, I think that's a very valid point, because if you are, say, on the board of a nonprofit and they are downtown, and it's a 25-mile journey down to the meeting and 25 miles back, over the course of a year, that can add up to a reasonable deduction. So it's good to know.
Yeah, actually, Phil just Googled that, and it's interesting because we didn't know that.
Yeah, see, that's why it pays sometimes to work with a tax professional. They can give you advice and help you and save you more taxes. And then many times they'll say it's possible they can save you more fractional fees. So that's helpful too. And you're on the right track as well, working with a tax professional. What I've done, Stuart, if you don't mind, is I've come up with a couple of ideas, a couple of tips that people follow, and even have time to do this, even though it's 30, tomorrow is the last day of the year. A couple of things they could possibly do to still save money in taxes for 2020. I have a little list here that I made. Would you mind if I went over some of these items? And
Absolutely.
On them? Is that okay?
Absolutely.
Okay.
Go for it.
Okay, great. First and foremost is I always say people need to save for retirement. Retirement is a great vehicle to put money away in. Money grows tax-free, and you get a tax deduction for it. I always say contribute to a Roth or a traditional IRA. Now, 2020, you have until your filing date, which is April 15th, 2021, to put away money for an IRA. You can still do it by the end of the year, but you have until 2021, April 15th, for your 2020 tax return. An individual can put $6,000 into an IRA, and if you're over 50, you can put $7,000 into an IRA, a traditional IRA. And one tip I like to recommend is, let's say you have a stay-at-home spouse that does not work. They always say that the spouse works in the home. You can't say they don't work. Correct. It's true, though. So if I have salary and I put away money in an IRA, you could put away money for your spouse for an IRA. It's called a spousal IRA. A lot of people didn't know that. So let's say you're 35, 40 years old. You're making 100, 150,000, 50,000, 75,000 in salary. You can put away $6,000, let's say, for an IRA. And it's possible you can also put away $6,000 for an IRA. Just two things. One, you get deduction for. Two, it helps with their retirement as well. So I recommend IRAs, whether you do a traditional Roth. That you don't have to do by December 31st. You can do that by April 15th, 2021 to 2020. There's something called an HSA, Health Savings Account. You can max that out. If your employer provides it, or it's done through your work, you can get funding for it on a pre-tax basis. So basically, you're saving taxes. In other words, let's say you're funding it $1,000. So what happens is, let's say your salary here is $100,000. You fund your HSA, you're only going to be taxed on $99,000. You save $1,000, and that HSA money is used for medical expenses. If you don't have an HSA at work, you can do your own HSA, a tax deduction for the money you contribute to the HSA. 2020, let me see what I have. Your HSA is $3,550 for single, the maximum, and $7,100 for a married couple. But you have to have a high deductible health insurance plan for an HSA. These days doesn't take much. Recently, we spoke earlier before about making charitable contributions. It's not too late before the end of the year to make charitable contributions. If anything, though, I would deliver the check or the cash directly at this point to make sure that they receive it by the end of 2020. You put it through the mail, then they may not get it on time, and it could be questionable whether it could be for 2020 or 2021. So you may want to deliver it by hand before the end of the year. There's something called one other thing. Sometimes people have appreciated stock, and we spoke about that earlier about capital gains on stock. Well, if you donate that stock, you could get the deduction for the appreciated value of the stock. Instead of paying capital gain, you get a charitable deduction. What that means is this: you buy stock for $3,000, and now the stock is worth $5,000. You decide to get it in, you have to pay $2,000 capital gain. If you take that $5,000 stock and you donate it to a charity, certain limitations, you get a $5,000 charitable contribution. So the question is, you have $5,000, you can donate it to a charity, or you can pay the capital gain tax on it. Depending on how that fits your tax picture, it's something that you might want to consider and think about, and run that by your tax person. We do something called bunching real estate taxes. Now, everyone hates paying their real estate taxes, and normally they're paid in January of the year. So what I recommend some clients do, depending on how they itemize, what they can do is they could take in December of 1 year, they can pay their, let's say, for example, their 2020 real estate taxes and the 2021 real estate taxes. Those together, that might push them over the threshold to itemize their deductions. Again, something you might want to speak about with your tax professional called bunching real estate taxes. Let's see something called a home office expense. Now, with the COVID and everybody being at home this past year, a lot of people work from home, and there are ways that you can deduct the home office expense. Strict rules and regulations for it. It's got to be regular and exclusive, and a whole bunch of other things. And you can take a portion of your home or your apartment, and you could write that off as a home office expense if, let me take a caveat there, if you're self-employed. If you have a W-2 and you get a salary, you can't deduct that. But, a lot of people out there, they have the gig economy, or they're self-employed people like you and I. So you can take a portion of your home or your apartment and write that off as a business expense, legitimately. It's something that you might want to speak about with your tax preparer. Work with a professional. As I said, at times it's better to work with a professional. It's just better to work with a professional. As I said, it's just good. I can't think of my expression for the moment. I'm drawing a blank right now. The other thing is, if you're self-employed, you have to buy supplies, you have to buy equipment, furniture, computers, business cards, rent, what have you. A lot of self-employed people are on what they call the cash basis. So if next year, at the beginning of the year, you're going to buy a couple of cases of computer paper, you're going to buy ink, you're going to buy supplies, you're going to buy a new desk, a new computer, buy it now, get the deduction for the end of the year. If you're going to be spending money, if you have the money to spend right now, the cash flow, get it out of the way, buy it now, take the deduction now. We'll figure out what to do next year for more deductions. So those are a couple of tips, and most importantly, keep good records. Okay, a lot of people will come into me without any records, and we got to recreate them. I will guarantee 90% of the time, getting records, people lose deductions. Keep good records. I recommend you have a business, have at least one separate business account. Run your expenses through the business account. Don't run your personal business account. Don't run your business personal account. Have a separate business account. Because this way you go in that account, everything in there. The money that went into the account is business income. The money that went out of the account is business expenses. You have to go and backtrack at the end of the year. You will lose expenses, almost guaranteed. So those are a couple of tips that I want your viewers to understand. and speak to their tax professional about it, because it's ways that they can save tax money and tax dollars between now and the end of the year. I hope that helps.
Yeah, those are great tips. And actually, it's interesting because Phil had asked me to ask you about home office deductions because he's not traveling right now with his company. He's not going into the office. And there's word that his company and some other people that we know that they might continue that new kind of work structure moving forward. So I guess my question would be, if in fact some of these companies move forward where they will not have their employees come back into the office again ever, even though they have the W-2, you're saying basically still because they're not self-employed, they cannot, this is not tax deductible to have a home office, even though they're not going into an office anymore.
Unfortunately, last year when they changed the tax law, actually a few years ago, they did away with something called employee business expenses. So if you work for a company and you were not reimbursed for your expenses, okay, you were able to deduct them on your tax return as an itemized deduction within certain limitations. When they changed the tax law a few years ago, they did away with that, and you can no longer deduct employee expenses, and part of that would be home office expense. On a positive note, a note about that though, your employee business expenses, if you were under a salary, was an itemized deduction. When they did away with certain itemized deductions, such that they raised the standard deduction to kind of make up for that. So it's not a total loss. They made up for it in other ways. But generally, right now, like in your situation, unfortunately, if your husband is a salaried employee, he cannot take a home office expense. However, okay, and this is legitimate, certain companies have what's called an accountable plan. And what that means is, as an employee, you can submit your expenses. For example, if you go out and you entertain people, you take them out for lunch or dinner for a sales call, or you have automobile expenses and things such as that. Okay, you can submit an expense report to a company, and they can reimburse you for it. That's not taxable income to you, and it's a tax deduction for the company. So you lost your employee business expense. So a lot of companies they put into place an accountable expense plan. Employees give them the exact amount of their expenses. They're reimbursed for it. Employees don't deduct it because they can't. They get reimbursed for it though, and companies still get the tax deduction for those expenses. It's kind of a win-win and a workaround for no more employee expense deductions on. So if you work for a company, ask them if they have an accountable plan and see if you can take your deductions that way.
You know, Robert, you brought up a point earlier about a home office deduction. Let's say I was an employee of a company and I was laid off because of COVID. So now I'm at home and I've set up a little home office in order to try and find a new position somewhere. Can I now deduct that time in my home office as a deduction?
Sorry to say, Stuart, probably not. And let me explain why. If you have a home office just for the sake of finding a new job, that's considered job hunting expense, and that's not deductible anymore.
Okay.
Okay. If I was laid off from my regular job and I decided to go widget business, and now I'm working widget business out of your home, you then can have a home office deduction. So a home office deduction has to coincide with the business. It can't just be there for nothing and for no other reason. It has to be there for business and has to have a business purpose. Does that make sense?
Yes. Yeah. Well, there obviously, the more questions that we have and the more answers we get, the more questions come up.
Yeah.
And it's, that's why it's important to have someone like Robert that can point you in the right direction. And all. Robert, if I may, if someone has a question, wants to run it past you, or they need your services, can they give you a call? And what's the best phone number for them to reach you at?
Okay, certainly. I'd be more than happy to help people if they have a couple quick questions. I'd be more than happy to help you viewers. I can reach, my best number is area code 214-244-2535. Let me repeat that. 214-244-2535. You can email me at at rgralla, R-G-R-A-L-L-A, at robertgralla.com. I'd be more than happy to help if I can. I do the best I can to help you, help viewers, and whatever I can do to help.
Well, I thank you very, very much for joining us, and I hope the waters haven't become too muddied for everyone that's listening and watching. It's important because I always say I want to give less to the government, and you mentioned, for instance, one very key point that you mentioned that I think is important. You have until April 15th in order to do an IRA contribution. So if, again, you find out as you're preparing your taxes that you're going to have to pay some pretty good taxes on 2020, you might want to take a certain portion of that money and put it into an IRA, and that way you can deduct it from the amount of money that you have to pay to the government. Am I correct on that, Robert?
Yeah, that's correct. That is 100% correct. And if you're self-employed, you can do a self-employed pension, and you have a little more time than that to put that money in. So there are ways through funding retirement accounts to save money in taxes. Once again, everyone's tax situation is different. Speak to your tax professional. They can help you the most with that type of plan.
Well, again, Robert, thank you again for your expertise and for joining us. And to Phil and to Vaughn, Vaughn, today's the day for you to kind of figure out if there was some extra money earned over the year, because you got until tomorrow to go out and spend it.
Got it. That's my takeaway from this conversation.
There you go. That's the takeaway from the show. So thank you again. That is our last show for this year. We will see you again next year. We wish everyone a very, very happy new year and a very healthy year ahead. And please join us again next week for another edition of Something to Talk About. You all take care and be well.
Stay well. Thank you.